Hi, everybody. I hope you're all staying healthy and safe during this pandemic. I feel so fortunate to be able to still work and help people during this time. It's a new normal to have my dogs as my coworkers, and let that be a warning to you if they randomly start playing and howling in the background. On a banking note, I'm so excited to be able to let you meet my behind-the-scenes team. They are fantastic. Marcus McKelson and Shannon Thorpe will soon be on here to tell you about how to budget in a pandemic, and if you absolutely cannot make your payment, what kind of options you can have. But before they talk, one of the questions I oftentimes get is, should I refinance? In general, if you can save money on your refinance, it's a kind of an easy yes. But how do you know if you'll actually save enough money to make it worth it? I'm going to share with you my 7-point blueprint so that it can help you make the decision on whether or not it makes sense for you or not. Right now, mortgage rates are incredibly low, but do you know what your current mortgage rate is? A good rule of thumb is if you can save at least 1%, it might be a good idea to refinance. Secondly, has the value of your home gone up? And do you maybe have high debt, like credit card debt, that you can't seem to get rid of? If that's the case, it might be a huge savings for you right now to refinance your home and put all of that debt into a lower rate. Maybe your credit has improved. Maybe when you bought your house, you had not a lot of credit and your credit score was not the greatest. Generally speaking, the better your credit score is, the lower your rate will be. So if you've worked hard at increasing your credit rate, then maybe now is a great opportunity for you to put a little bit more money into your bank account and a little bit less onto your interest of your loan. You should calculate your break-even point. Figure out how long it will take for your refinance to pay for itself. Yes, it can do this. To do that, divide your mortgage closing costs by how much money you're going to save each month. For example, if it costs you $3,000 in closing costs and $150 is what you'll save each month, then it will take you about 20 months or a little less than 2 years to break even. Now that might sound like a lot of math, but don't worry. You can Google mortgage finance recalculator, mortgage refinance calculator, and there's a lot of things out there that will help you. Also, consider the term of your new loan. Maybe you took a 30-year loan out in the beginning and you've been paying that for close to 10 years. And now you're looking at taking another 30-year mortgage out because it's got a lower rate. But remember that a lower payment with 30 years still means that you are stretching that interest out and could potentially be paying way more in the long run. Refinancing, kind of on that note, usually makes more sense if you're in the earlier years of your mortgage, because in the earlier years of your mortgage, the bulk of your payment is probably going to interest. So if you have been paying for 20 years, like we said before, it's probably not a good idea to refinance. But if you've only been paying your mortgage for 2 or 3, this would be a good time. Lastly, figure out whether or not you're willing to invest the time, the effort, and the money into refinancing. It's important to understand all the different mortgage options that are out there and to work with someone that you trust. Excuse me. This is Sophie, everyone. She apparently is not happy that I'm not talking to her. So I have just gone through all the 7 points of my blueprint. I'm happy to help you determine if it's a good decision or not. But maybe you're not at the point of you thinking about refinancing. And so I'm going to introduce you to Shannon, and she can help you with some great COVID-19 budget tips. Bye, everyone.
Thank you, Amy. Hi, everyone. My name's Shannon Thorpe. I'm a mortgage processing specialist here at Home State Bank. I wanted to talk to everyone about budgeting during this COVID-19 pandemic. The right budget can help minimize the damage COVID-19 does to your finances. So what is an emergency budget? An emergency budget is a budget that you set up when you need to cut out all unnecessary expenses in order to survive. It is something that you should have in place as soon as possible, since emergencies do not give you any time to prepare. Luckily, we live in a world where resources are available at our fingertips from budgeting apps on your phone, or even if you type in budget templates into Google, really the options are unlimited. Here are some general rules to follow when you're creating an emergency budget. Number 1, buy what you need, especially groceries and household goods. Put off the non-serious expenses. While it's up to everyone to really determine what is important for their lifestyle and specific needs, this is a time to really sit down and evaluate your shopping habits. Canceling or pausing subscriptions that you can live without for a while would be a good example. I know this is a hard one. I personally love my subscriptions, but just remember that this is not forever. Number 2, hit the pause button on your financial goals. If you are currently trying to pay off a debt or trying to stash into savings for a big purchase, just pause. For right now, simply pay the minimum payments as you need to focus on preserving your money. In times that are uncertain, it's best to delay your goals, even if it means having that extra cushion for necessities. 3, lowering your fixed expenses are also things you can do for emergency budgeting. You can't avoid paying for these things, but just making yourself more aware of how you are using utilities, such as turning off the lights when you leave a room, unplugging unused appliances, hold off on watering your lawn, and even lowering or turning off your thermostat by opening windows in the long run can really help lower your bills. Also, now would be the perfect time to shop around for better rates on your mortgage, car insurance, cell phones, internets, or even streaming services. But lastly, be prepared, but don't panic. Yes, things will be tight, but we have this amazing ability to adapt when things get tough. So just know that we will make it through and that emergency budgeting is not forever. So ease your mind and take comfort in knowing that you have a plan in place. Take precautions, stay educated, stay safe, and practice social distancing. Now I'm going to pass it over to Marcus, who will talk to you about forbearance.
Hi, my name is Marcus McKelson, Loan Underwriting Specialist. I hope you found some good information from Amy and Shannon about how to save money through refinancing or reworking your budget. If you're among those financially impacted due to COVID-19 pandemic and are concerned about making your mortgage payment on time, there are plans to help you. However, if you can pay your mortgage, please pay your mortgage. If you can't make your mortgage payment, you have the right to request a forbearance. What does that mean? The Consumer Financial Protection Bureau defines forbearance as when your mortgage servicer or lender allows you to temporarily pay your mortgage at a lower payment or pause paying your mortgage for a limited time while you regain your financial footing. Forbearance doesn't mean your payments are forgiven or erased. You are still required to repay any missed or reduced payments in the future. Here are some things you'll want to consider about forbearance. The terms of the forbearance plan will be given in writing and will include what to expect as a borrower during the plan period. The payments which are the subject of the forbearance have only been delayed or reduced, not forgiven. You may shorten a forbearance term at any time to reduce the amount of payments being delayed or reduced. Initially, up to 90-day forbearance can be made. At the end of the 90-day plan, it will be assessed to see if a workout plan can be started or if a plan needs to be extended. The plan can be extended or shortened. Each situation will be assessed to determine if the extension of the original forbearance is the best workout option. The total forbearance plan cannot exceed 12 months. The forbearance reduced or delayed payments will not harm your credit rating. Interest will continue to accrue at the loan rate during the forbearance period, but will not be compounded on the missed payments after the forbearance time period has ended. In addition, no late fees, administrative fees, or other such fees will be applied to any of the payments that are part of the COVID-19 forbearance plan and will not be included in the workout repayment plan when the forbearance term has ended. Forbearance repayment plan may last up to 12 months. The repayment plan payments are made in addition to the borrower's regular monthly payments. The repayment includes the full amount of delayed payments, which includes principal, interest, taxes, property and mortgage insurance, and any other permitted property and mortgage insurance, and any other advances permitted by applicable law. I realize this was a lot of information in a short amount of time. It is my sincere hope that COVID-19 pandemic has not affected your finances to the extent that you will need a forbearance plan. But if you find yourself in this situation, we are here to help. Please call us and we will kindly help you through this difficult time. Thanks for watching and be safe.